During 8 years of full-time trading, I've placed thousands of trades, some of which have been multi-six figures. I've also made every mistake in the book and have experienced huge losses. And I've also worked with people from all over the world designing trading systems that me and others have been able to use to scale up to making thousands of dollars per day. But when you're just getting started, there's so many areas that can get you completely lost. So today I'm going to be boiling down everything that I've learned over this time period. I'm going to show you things that are going to get you started trading without needing any money, how to set a goal, actually hit it, and build an income generating machine for yourself, and give you an actionable business plan, as well as the tools and resources that go along with it. And if you're able to make it through this 20-ish minute video without clicking away, you're going to essentially get 8 years of experienced trading information that I promise can take years off your learning curve, regardless of your current experience level. All right, so now let's get into a more detailed version of exactly what I'm going to be showing you in this video. First, I'm going to show you critical things that you should be starting with so that you don't confuse yourself. Then I'm going to go over the mindset required for successful trading, which may not be exactly what you think it is, how to win and lose correctly, how to build an actual trading plan, how you can start trading without needing any startup capital at all, and how to actually hit your goals by reverse engineering your thought process. All right, so when you're learning trading, there's going to be a million resources online, a million people saying all sorts of different things, and trying to learn everything at once is just going to information overload yourself and is oftentimes going to create more confusion and more disorganization than it's actually going to help you. And it's going to shoot you away from actually achieving a straight path to succeeding. What you really need to understand at the beginning is actually just a core few principles, and then once you have that principle down, is basically add based on your understanding of the core principles. So what I want to do is basically explain trading as a whole. And this is something that took me several years to actually simply understand. And starting with this explanation is going to eliminate so many issues for you. So let's take an example of a coin flip. And I want you to really think about this deeply. If I said to you that every time we got heads, I would give you $2, and every time that we got tails, I would take $1 from you. Just ask yourself right now, how much of your own money would you be willing to risk on this process? Depending on how you answer this question is sort of going to show you where you need to start off in this learning process. Because trading is a game of probability and statistics, and I'm going to show you a very simple way to actually look at this that is going to change the entire way you look at trading. So first, I'm going to start off by doing 10 coin flips, and I promise this is going to start making sense in a second. Okay, so you can see, even though we know statistically speaking, whenever we flip a coin, it's a 50-50 shot. Over our 10 flips, we only got 3 heads and we got 7 tails. So in the scenario that I just painted for you, if every time you got heads, you got $2, but every time you got tails, you would lose $1, you would have made plus $6 on wins. You would have lost $1 7 times, which would have resulted in negative $7. So even though we know coin flip is 50-50 and you would make double when you got heads opposed to tails, because we only did 10 flips, this actually resulted in a net loss of $1. And this same phenomenon is one of the most important things to remember with trading because of a concept which is called the central limit theorem. Okay, so we're going to take a look. This first scenario is 5 flips. Okay, obviously we know it's a 50-50 shot. So off of our first flip, we got tails. On the next flip, we got heads, which brought us back to that 50%. And then we got tails 3 times in a row. And you can see once again, off of a small sample size, the true probability of 50% wasn't shown in the data set. Now let's go to 30 flips. We start off with heads, we get tails, we go back to that 50%, we get tails, tails, heads. And you can see after 10 flips, we're still not at that statistical true probability of 50%. Now let's take a look at 100 flips. We started off with tails 2 times, got a heads, and you'll notice as we did more and more flips, even getting a ton of heads and a ton of tails in succession, by the time we hit about 50 to 60 coin flips, this line started to trend closer and closer to that 50%, which we know is statistically true. If we take a look at 1,000 flips as our example, once again, as we hit about 200 flips, the more we add to this data set, the closer and closer this line is to following that exact statistically true probability. And if we go back to our original example, say we did 10 total flips, so we had 5 heads and 5 tails, we would have made $2 times 5, which would have given us plus 10. And then for our tails, we would have had negative $5, leaving us now with a profit of $5. So our job as traders is to come up with a strategy where we can find certain conditions that are going to put us in situations where we can get into the market, and instead of risking, say, $1, say we're risking $500. Okay, and if we can design a system where we know that half the time price is going to move here before it's going to move here, you can see so long as we enter with this quantity, we can risk the $500 and have an expected profit of double that at around 1,000. And you can see just as an example here, this is a trade I took with $500. I had my key area picked out. I was able to figure out where price would likely make a move. And you can see I got a really, really significant move from the area I risked to the area I wanted to take profit, allowing me to go up $5,000 in profit, risking $500. So a little different than that $1 or $2. So the point of trading is figuring out, based off of what you do in the market, what your statistics are, just like the coin flip, and how you need to position yourself to be able to, over time, end up making more profit than you lose. Okay, so if you can solve that in the market, you've basically solved trading. And the more simple you can keep that in the beginning, like I was saying earlier, the easier it is to understand this data and put yourself in a position where you're statistically going to make profit. But you have to know how to actually apply this, and that's what we're going to get into right now. And this largely has to do with the next thing that I'm going to share with you, which is the mindset required for successful trading. One of the biggest mindset changes that I applied is considering each trade that I took 1 out of 100 out of 1,000 next trades, and putting very little significance on the actual trade result that I'm taking currently. It's really easy to fall into the emotions of wanting to make a profit, being right about your idea, but these are things that you need to completely throw out of your mind. And that's because if we go back to our statistics example, if we know the success rate of our result over time, but we're only doing it over, say, 5 trades, even though we knew statistically our strategy would work 50% of the time and make us double than what we were risking, if we only did it over 5 flips, as we saw in multiple examples, you could still end up losing money. And this psychological phenomenon leads into so many other issues that I'm going to get into in just a second. All right, but you can see if we did that same exact thing over 100 flips, that's where we're actually going to start getting closer and closer to our process. People say to me all the time, you must have nerves of steel to be able to trade. You must love the adrenaline of gambling. I don't gamble. I don't like to gamble. I also don't need nerves of steel when I'm taking trades, because if you're getting emotional about the outcome of an individual trade, it means you don't trust your process, and it means that you don't understand statistics. Anyone who's really leaning into emotions is likely adding a bunch of different variables and a bunch of different decision making, which is going to steer them further and further from their model. That's where that anxiety and the stress of caring about the outcome of each individual trade comes from. As long as we follow our process and we do 100 flips, we know it's basically statistically impossible to not make money over time. Then it becomes a game of how closely can I follow my rules. Then you start framing your mind to think each trade that I'm taking, the risk I'm putting on the table is simply viewed as opportunity cost to be able to make money over time. And if you lose it, it's just adding more and more opportunities into the market to be able to let your edge actually play out. So really what we're leaning into is having long-term patience for our process, having psychological control by understanding and trusting our process like a business, and relying on consistency over luck. So now we're starting to stack up some of the traits that need to be applied into trading. So doing these things is already going to put us in a way better starting position. But in order for this to come together, I want to talk about the next big thing, which is how to be able to win and lose correctly. Because there's a lot of traps that even if you understand this and you're not aware of, can lead you into the pit of despair. So one of the first things that you need to do in order to win and lose correctly is to actually remove money from the entire trading process. And even though it sounds counterintuitive that we have to forget about the money in order to make money, that's the number one thing that we need to do. Okay, instead of using money in order to start building this process out and focusing where we need to put our focus on, professional traders use something called units of R, or units of risk. So once again, if we go back to our coin flip example, if we landed on tails, we were willing to give up -$1. So in trading, that would be considered our 1 unit of risk. Whereas if we hit heads, we would get $2 of profit, and that would be equivalent to making 2 positive units of risk. Okay, so just like the coin flipping was a process, trading, having a rule set, knowing our own statistics, is a process that we follow that is either going to generate negative risk factors or positive risk factors. So if we decided we want to enter the market here based on our rules, we think this price is going to be reached before this price. Say we want to risk $100. Now you can see we have to enter with this exact quantity of whatever we're trading, so that if price comes down here, we're risking 1 unit of R, which in this case would be $100. And if price plays out in our favor, we're able to profit $200, which is also plus 2 units of risk. So when we're building this framework, we want to look at money as a byproduct of being able to build a system that is going to generate us positive risk factors over time. Okay, and another reason this is extremely important is because if we're adding money to the process, now we start judging the quality of the trade on whether or not we made a lot of money or we lost money, regardless of our process. Say for example, I risked my entire account and made $300, but I was risking $15,000 on that trade. If I told someone, hey, I made $300 trading, they'd be like, oh, that's awesome. Like, good for you. That's amazing. If I said I lost $500 trading today, but I know over time that I'm going to make money and that I followed all of my rules precisely, just looking in terms of money, especially people who don't understand trading are going to be like, oh, what happened? That's terrible that you lost money. How can you change your behavior to prevent yourself from taking another loss? And you'll start judging what you need to do trying to chase money rather than focusing on the process that you know, once again, over time is going to get you to that end result. So the amount of money made or lost on any given trade has nothing to do with whether it was a good or bad trade. The only thing that matters is how closely you adhered to your your technical process, which is going to give you your outcome over time. If you start changing things up, say for example, we take a trade here risking 500, we make 1,000. We take another trade right here risking 500, we make 1,000. And we say, okay, I'm up $4,000. If I can just risk $4,000, I can make $8,000. And so then price comes here. Now you're changing your behavior based on the emotional response to money, whether it was a win or loss. And now you lost all of your profit and you've completely thrown off all of your metrics because now you're risking different amounts of money based on how you feel. And you're further deviating from the process that you know works. This is something called the hot hand fallacy. Okay, it often happens in sports. If a player is doing really well, people will say that the player's heating up and they'll start betting more and more money, thinking that just because they've had success in the past, they're going to continue to have success. Whereas based on statistics, whether something is going to happen or not is a completely binary option. Okay, and every trade that you're entering into the market has no relevance. It does not care what you did previously. Okay, so avoiding this hot hand fallacy or cold hand fallacy where you start changing behavior, say you're on a losing streak, so now you start risking more when your edge starts playing out, but now you have less risk on the table, your reward is also smaller. Once again, you're deviating from these statistics based on your emotions that are largely tied to money, okay, which this whole game is geared around adhering to your process that you know works and letting it play out over time. Okay, imagine we took our coin flip example, but instead every third tails that I'm getting, we're throwing in a -$5 opposed to a 1. All of our metrics are completely out the window because we've changed one thing. So all of this is really good psychological framework, but now we need to get into the process of actually building our trading business plan, because trading is a business. And if you have a business, you have people working on analyzing statistics, trying to optimize, measuring things constantly and figuring out what's working and what's not. And in order to be able to troubleshoot things that aren't working and continue doing things that are working, you need to have a benchmark to measure. And if you don't, you're just throwing random things out there. You're never going to be able to optimize. You can't improve what you don't measure. All right, so here's how we build a trading business plan. First thing that we need, of course, is a trading strategy concept. And this is going to come from observation. Okay, so this can be a series of different things on our chart. Say, for example, every time we see one of these green arrows, that's where we buy. And then whenever we see a red arrow, that's where we sell. Okay, I'm not saying this is a strategy, by the way. I'm just using it as an example. Okay, and say we do this over 30 examples. So right here, I made almost 5x what I risked. Over here, I made 7.5 what I risked. That's already 12.5 R. So we've observed that this is working. Next thing that we need to do is have defined rules. Once we see this arrow marker, we enter. Once we see this arrow marker, we sell, and vice versa. Once again, that's a simple example, but that would be us defining exact rules. Okay, and then the next thing that we need to do, okay, over a sample size, evaluate the outcome. And so what we need to pay attention to is the percentage of the time that we're winning and the average win versus loss size each time we take a trade. Okay, and that's going to be measured in R. So once again, going back here, we don't really care how much money was on the table. We know we made 4.84 R, and on this we made 7.53 R. And based on evaluating this outcome, this is basically the only thing that we need to look at to see whether or not our trading strategy is something that we want to put into the next phase of testing. Okay, so just like our coin flip, we had a 2-to-1 risk reward ratio. If we got heads, we got $2. If we got tails, we lost $1. You can see 50% of the time, that's going to put us in a profitable situation. So say, for example, we're only right 30% of the time, and say we're wrong about 70% of our ideas. As long as we're making 4x what we're risking when we are right, even being wrong 70% of the time is going to put us in a profitable situation. So those two metrics are going to allow you to see how your process lines up with profitability. And if you are in the green, now we have a strategy and an idea that we can actually start implementing. All right, so now let's get into how to actually start this trading process without using any money in the market to get to the point where you're actually scaling accounts and building that income machine for yourself. Once again, this is something that you should be doing without putting any money into the market. Okay, people like to screw around and say, I'm just going to dabble. I'm going to put some money into an account and see what happens. That's like starting a restaurant where you don't know anything about food. You don't have any chefs. And now you're expecting for people to come in and pay you and to be successful while you're competing with people who have professional chefs, professional menus, and have their business established. Okay, this is a way that we can get complete proof of concept to know that we're going to be statistically profitable. Trading is basically the only business where you can do a complete dry run without risking any capital to figure out whether the business works or not. This is one of the craziest things to me when I hear people say that I threw $3,000 into an account and lost it, and that was my attempt at trading. If you apply this, you can save all of that headache, and this is something that I wish I did in the beginning. So what we're going to do in this process is something called back testing. All right, and I'm going to give you a resource in a second that's going to make this a lot easier, where you're going to see all of your data. I'm going to show you how to get access to that in a second. Okay, but first thing that we're going to do is start on charts. So exactly what we looked at here. We're going to pick something to trade, whether it's crypto, stocks, futures, doesn't matter. And we're just going to make a visual observation of where we would place our risk and our take profit. So if we're selling here, that's one loss. All right, so you can basically just mark off -1R on your chart. All right. And what you're going to do is run this for, I would say, no less than 30 trading days, because based on the central limit theorem and statistics, you need a sample size usually of about 30, but the more trades you can put into this, the better. What you're going to do is first keep a tally to see if this idea is actually producing positive risk factors over time or negative. Once you have a process where you've gone through the on chart and you know that this idea works, then you're going to go do something called a bar replay, and you're going to do this process over. Okay, but this time what you're going to do is click this button on Trading View right here. You can either select a specific time or you can put it to a random bar. Say we click on random bar, then we can click play, and now we're waiting in real time for our signals to come in. All right, so say we're buying here. Once we get this notification, sell signal here, that's 2.5R. Now we're going to test our in real time decision making, because when you're building a strategy, if you're looking at it after the fact, these signals are going to be a lot more obvious. Whereas if you're flipping one bar at a time, now you can see your real time decision making. Okay, and you'll do this over however many trades. I would say, once again, at least 30. And keep in mind, this is supposed to be a diminishing process. You can sort of consider this as like a filter, right? And that's why we're doing this. The next thing that you're going to do is paper trading. So now instead of demoing this, you're going to jump to trading the markets in real time with either a prop firm, an exchange, okay, whatever you're trading on. And you're going to be using simulated funds, but now you're going to be forced to actually execute and place these trades. And once again, see how many units of R you're going to make over that time frame. And once you get to this paper trading section, this is where it's really, really important to actually start journaling your trades. So I built this trade journal here. It's going to show you an equity curve. It's also going to allow you to click right here, put the date. Say you're trading today. You can pick the day. You can pick whatever you're trading, the pair. You can input your own strategies, all this other information, and whether it was a win or loss, and how much profit you were able to make on any given trade. This is going to give you your winning percentage as you check these off. This is going to give you your average size win. If you just highlight this filter here, this is only going to show wins, which will then allow you to see your average size win. Say you're risking $100, that would mean that the 4.65 risk factors, so you can easily calculate your R. Okay, so you can either do this in dollar amounts or you can use R. Additionally, I put a checklist in here. You can customize this and sort of follow along with your strategy. Okay, on the private side of our team, we have a more advanced version of this, but this is a free version I built for you guys. If you want access to it, follow me on Instagram in the description. DM me the word tools and I'll send this over to you. So if you follow this process and you have a positive result over your time following your procedure, then and only then should you go to a live account where you're actually putting money on the line. So you can basically dry run this process and focus on just implementing that same exact core principles with a small amount of capital. That's going to allow you to sidestep all of the unnecessary losses, confusion, and the wasting of time. Okay, but in order for us to actually start trading, we need to set our goals and know how much money to actually start trading with. And I think this is one of the major make or break things where you need to rewire your brain to actually be able to hit your goal. And I think this is one of the major make or break things where you need to rewire your brain to actually be able to hit your goal. So most people, when they start trading, they have an idea of how much they want to make per day. So they set that as a dollar amount daily profit goal, and they make the mistake of setting a daily profit goal. Okay, and this is the exact opposite of what we want to do to actually be able to succeed. Okay, so this may sound a little counterintuitive, but what we need to do is reverse engineer this process instead of chasing a dollar amount. Okay, because what most people do, say they want to make $6,000 per month. So the next logical step would be to break this down into steps. Okay, say I'm trading 20 days per month. That would mean that we would have to make $300 per day as our goal in order to reach our monthly objective. Okay, this seems like a logical progression, but like we saw with our other example, we are not going to get an even distribution of outcome until we let our edge actually play out. And what oftentimes happens is, now say for example, you trade the first day, but instead of making $300, you actually lose $300. Now the next day, not only do you have to make $300 again, but you have to recoup the loss and make another $300 on top of it to make up for the day that you lost. And then you have to additionally make another $300 in order to catch up to this goal. And what you're going to do is, once again, gearing it around money, you're going to start changing behavior. You're going to start putting more risk on the table, trying to catch up to your goal. And it's going to deviate from this process that's actually going to allow you to get to your goal. Okay, so this is the exact opposite of what we want to do and why we don't set daily goals. Here's how we do it instead. Okay, and this is hyper important. So if you have a trading friend that needs to hear this, make sure you send this video to them, because this is something that took me so long to learn. Okay, step one, in order to actually hit your daily profit and your monthly or however long goal, first thing you need to do is get your personal metrics. And you need to figure out how many total trades you took in a month or over your time period. Once you figure out how many trades that you took, you need to figure out not how much money or anything else, how many R factors were made over that time. Then you need to set your goal. So we're going to take our dollar goal of 6,000 and say over this total period, we made 15 R. We're going to take that 15 R, and that's going to, by default, tell us not how much we're looking to make per day, anything else, how much money we actually need to risk per trade. How big does our 1R have to be? So in this situation, our 6,000 divided by our, say for example, 15R over this duration would give us our per trade risk required of $400. Then we take that and we focus on the process that we've been focusing on this entire time. And by default, we arrive at this $6,000 total goal for the period. Okay, we've also effectively gotten to our $300 per day goal, but never once have we focused on trying to hit a certain benchmark on a specific day. All we've done is reverse engineered our success by figuring out how much we need to risk per trade and focusing on the process to let our edge play out over time with the system that we know works. Okay, and this is how we have private team members that are 5xing their account, winning 35 trades in a row, getting funded traders basically every single day. And you can notice how each member is focusing on 9 units of risk, 32 units of risk. That's crazy. 21 units of risk using one of our proprietary strategies. With those risk factors actually being able to hit really, really nice trades. You see 11R, 6.2K in profit. Okay, and in the trading world, there's a lot of trading communities. And what I will say is even though it's awesome to see the team doing well, trading is an individual game. Okay, there's lots of trading communities out there. There's a lot of people talking about different things. Focus on the core. Don't listen to outside voices. Make sure that you have your own personal framework and you focus on your psychology and your implementation. You have your proof of concept and make sure you're treating trading like a business and arranging your goals properly. If you're interested in learning more about our trading team, I'll put a link right here. If you want to learn other trading things for free, I'll put another playlist right here. Subscribe if you want to follow along with new videos. And until next time, I will see you all in the next one.